there are three scenarios, and for equity, there are how many? Two, that mirrors how management runs its business. So that is what the changes from IAS 39 rule-based to IFRS 9, which is what based? Principle based on how we run the business. So that is it for investments. And I now turn you over to Dwayne to the exciting part of impairment.
As I said, right. So one of the key points I think which is important in keeping with the title of our presentation and auditor's perspective is that compliance with IFRS 9 does not look the same for everyone. Because the standard is largely principle-based instead of being rule-based, what matters is the principles on which your business is run. So two companies with the same asset portfolio may end up with different classifications in accordance with IFRS 9. How does that apply to you? You need to document the basis on which the business is run. Your business may hold a bond purely to collect the cash flows. Another business may have enough loans and treat investments purely as a liquidity buffer. All right? What you document in respect of your business purpose for holding these investments is what your auditor will use to assess whether you've complied with IFRS 9 or not. So it is not a black and white standard. There's no right and wrong answer. There's consistency, and that consistency must be backed by some documentation at the business level of the purpose for holding these things. All right, and as we go into the impairment, I want you to hold on to that idea, because while some of the aspects of the standard may seem very complex, by and large, it is principle-based and based on how the business is run. So you need to understand how your business is run to be able to comply, and compliance will be different for different entities. So just by a show of hands, how many people in the room are familiar with the PEARLS approach to providing for bad debts or bad loans? Great. I think the PEARLS approach is one which I think commonly forms the foundation for what credit unions have used in the past. Same show of hands. How much familiarity is there by people in the room with what IAS 39 requires, which is currently applicable under International Financial Reporting Standards? It's like around the same number of hands. Okay. Now, IFRS 9 introduces three concepts which I just want to touch on here. Overall, we're moving from an incurred loss model under IAS 39 to an expected loss model under IFRS 9. And that introduces three concepts. The first is loss given default. LGD is no different under IFRS 9 than it was under IAS 39. What you need to figure out is if someone defaults on a loan, how much is the business going to lose? All right, so today, a person defaults on a loan. What do you think about as a credit union? You think about the collateral you have, you think about the balance they owe in you, and what is the difference not covered by collateral. And then you think about how quickly you can dispose of that collateral. So if it is cash, because I know credit unions, some have deposits, can you liquidate those deposits to cover the balance that they owe in you? If it is shares, there may be a slightly different process in netting the shares against the loan, but again, you go through that process. If it is a more physical collateral, like a motor vehicle or a property, I'm sure there's a process by which you determine, do you want to go and try to auction off that property or motor vehicle to recover some value of what the person is owing you? In some instances, you'll have more collateral than the balance they owe you, and you may actually be able to auction and pay the member a balance and crystallize and pay off the loan. In that case, the loss given default is zero. In cases where you have collateral, the loss given default under IAS 39 and under IFRS 9 are no different. All right, so from that perspective, there's no change. Exposure at default is a change. IFRS 9 thinks about your exposure at a future point in time. IAS 39 only looks at your exposure at the balance sheet date. So if I'm at December 31st, 2017, and someone owes me $10,000, that is the balance that I'm thinking about when I try to assess my bad debt provision. IFRS 9 requires us to look into the future. How far into the future? Depends, and we'll cover that on the next slide. But what we're trying to figure out is if that person has not defaulted as yet, what is the chance that they will default before they pay off the loan? All right, and that is probably the most difficult element of IFRS 9. And that's where we get into probabilities of default. That chance that they're going to default within a period of time. Very simply, as a credit union, you will know what your delinquency history has been. You may know that historically you've had a 10% delinquency rate, so there's a 10% chance that one of your loans is going to go bad. In effect, that is your probability of default. That might be your probability of default now, but IFRS 9 requires you to think about how that could change in the future. What could happen external to the credit union, which may cause that to get better or to get worse. How far we have to go into the future is what we start thinking about here. So IFRS 9 introduces 3 stages in the impairment discussion. Again, I'll start at the end. The 3rd stage is where the loan is impaired. That is no different under IFRS 9 than it was under IS 39. IS 39 introduced a 90-day threshold as the trigger for impairment. Where a loan has not been paid for 90 days, the assumption is that it is in default. And you should start thinking about what your loss given default is. What is that balance minus collateral that I'm going to lose if this person does not resume payments? What can I get if I start liquidating collateral, and what will I lose? Okay, so that has not changed. What has changed is the introduction of a 2nd stage. The 1st stage actually existed under IS 39, but it was not necessarily approached in a consistent manner, which is what is called your active provision. So IS 39 introduced this concept that loans which have not yet defaulted need to be considered for an impairment provision at a general level because of the fact that you don't have perfect information about what is going on with your members. All right, so we need to assess what is the chance that something has happened which renders that member unable to pay their loan, but the credit union doesn't have that data as yet. So it requires a general provision. The approach under IFRS 9 is to try to estimate within the next 12 months what could go wrong. So if I start by saying my delinquency rate is 10%, what could happen in the next 12 months that makes that better or worse? Will oil prices go up or down? Will my GDP within the local economy change? Or if my credit union is sufficiently exposed in a particular sector or particular industry, what could happen in those industries that could make the credit union exposure more risky or less risky? And under the first bucket, you only need to think 12 months into the future, which itself is difficult, all right? Under the second bucket, you need to think what could happen between now and the maturity of that loan. So if it's a demand loan and it's a 3-year loan, we need to think about what might happen in the next 3 years. But we start by saying our current probability is 10%. And then we try to figure out what could happen in the next 3 years that makes that better or worse. Okay? If you have a mortgage portfolio, you might need to look even further into the future. What stays in bucket 1 and goes into bucket 2 is a matter of both absolute credit quality and relative credit quality. Absolute credit quality, the standard introduces a 30-day threshold. Many banks, and I know some credit unions, will start to watch list loans once a month has passed and a payment has been missed. IFRS 9 says once that has happened, the loan automatically moves from bucket 1 to bucket 2, and you start to think more than just the next 12 months. You start to think to the end of the loan. Okay, so if this person has 3 years of repayment still to make, what is the chance that they can continue paying over those 3 years? That 30-day threshold is established under IFRS 9 and is a presumption, so that things that are past due between 30 and 90 days fall into that bucket. All right? It is a presumption which can be rebutted, but you actually need to do some work and some analysis to show that your loans that have gone more than 30 days past due generally recover because of the relationship you have with your members or because of some other way that members operate. Okay, so this is the most complex part of the standard, but how it is applied is different for everyone because the levels of data that you have about your members may be different, which is why we think a collective approach makes sense, because I'm sure the trends that face all credit unions and the data we have within the market in Trinidad and Tobago is going to be similar. So you're going to face similar challenges, and you're going to come up with similar solutions. What are the challenges? Data availability is the first thing. IFRS 9 was designed outside of the Caribbean. It was built outside of developing economies. It was built in economies that are used to having perfect data. They have credit rating scores for individuals and companies that can be obtained publicly. We don't necessarily have that. Okay? So one of the huge limitations is going to be the data that is available. That does not mean you cannot comply with IFRS 9. It just means you comply in a different way. Critically, IFRS 9 is a multidisciplinary endeavor. And I say that to say it requires involvement of your IT team to understand what data you have and can have available. And it requires discussions with your credit committee and the branch managers who grant loans and who review loans on a regular basis. If your finance team tries to implement this standard on their own, you're going to get results that the rest of the business does not like, because it won't make sense. It's principle-based, and it's based on how the business operates. So the people that run the business in terms of granting loans and following up on collections, and the IT team that knows what data is collected are critical. You have two options: buy a model or build a model. For an investment portfolio, when you're assessing impairment, it is usually not difficult to do that on an investment-by-investment basis, and an Excel model could be used. Where you have a loan book with thousands of members and hundreds of thousands of loans, an Excel approach may not be sufficient. There are models that are available to be bought. PwC does have models that can be sold. But one of the mistakes that is frequently made is people buy models without understanding the data they have available. So they may buy a model which is developed on Oracle because they run Oracle software, but that model is based on data which normally is available in the US, not the data we have available in the Caribbean. So building a model may make more sense, and building one collaboratively where you can share information may even make further sense. Technical purity versus practicability. There are different ways of complying with the standard. There's a best practice way, but PwC has identified many acceptable ways of complying with the standard which are not the best practice. There are things that you have to do for minimum compliance, but there are also things that are not required, and based on the data that is available, you can make a case to comply somewhere along that spectrum. Okay? Systems integration is important. If you're running an Excel model, it will be difficult because most of your customer and member-related data resides on your operating system. If you can't link those systems, the amount of time and manual intervention required to comply with IFRS 9 may not make sense. Okay? So you need to understand what data is available and needs to be fed into the model and figure out with your IT team how that can be done in such a way as to minimize the requirement for manual work every quarter or every year. The last part, it is an incurred loss model that we are under now. So while your historical delinquency ratios may have been used in the past to come up with your general provision, there's now some element of forecasting which is going to be required. So as a business, you need to understand what's happening in the economy and try to apply that onto your delinquency ratios. What will a change in GDP in the next year do to my delinquency ratios? What has it done in the past when GDP went up or went down? Again, there are very complex ways of looking at that projection, but there are also simpler ways which are doable within our economy. Some of the things to think about in terms of data. this relates to the internal information you have. So questions credit unions should be asking themselves. Do I have a record of the origination date of the loan? Do I know when the loan was granted? So the loan is on my books now. I know the maturity date. Do I know when that loan came on? Was it 5 years ago? Was it 10 years ago? At that point in time, what assessment did I do before granting the loan? What data exists? Do I know what the member's debt service ratio was at that point in time? Do I know what their shares to loan value was at that point in time in relation to my ratios for approval? All right? Having that information will make compliance with IFRS 9 easier. That information may reside within a system or it may reside within a paper file which sits in an archive somewhere. You need to answer the question of how accessible that information is. That makes compliance easier. It makes the number that you're going to have to put in your financial statement smaller in most cases, because having that information allows you to get more of your loans into the first bucket, where you're only talking about a 12-year forward forecast, rather than the second bucket. Okay? There are simplifications of the standard. The 30-day threshold is a simplification which can be applied without any data on historical information. Now, I'm sure most of the credit unions will have an aging report of their loans, which will tell you whether a loan is performing or past due and how many days past due it is. Once that 30-day threshold is crossed, you start to move buckets. Once a 90-day threshold is crossed, you move again. The loss that is recorded is a function of the probability. You can also go backwards. So if something becomes impaired and you have to take a full provision, but based on discussions with the member, it is no longer impaired, they're able to come in and make a payment or pledge more collateral, you can actually get out of bucket 3, go back into bucket 2. If something was more than a month out of payment and the person has come in and paid up and you're confident they will continue paying, you could go back into bucket 1. All right, so it doesn't stick you in a bucket for the rest of the loan unless the circumstances don't change. What do you need to try to figure out in projecting? You need to try to figure out what are the key variables that affect your members. So if your members are within a certain industry, how does what happens in that industry affect the credit union's exposure to risk? If your members are spread over the economy, how does what happens with the GDP affect the credit union's exposure to risk? Once you decide what the main variable is, then you start identifying sources of data, whether it is central bank reports, whether it is the CSO, whether it is stuff that you can collect externally. Once you identify that variable, then you start thinking about scenarios. What could happen in the next 12 months? When we get internationally rated by Moody's or Standards & Poor's, there's usually an outlook attached to that, where they say the likelihood of things happening within the next 12 months is either positive, negative, and you can use that to look at the next 12 months. It may be difficult to project further than that, which is why having that data and being able to start off in the first bucket makes life a lot easier. Okay? What is required by the standard is in doing that projection, you consider multiple scenarios. It doesn't say how many. For each variable you identify, there should be at least 2 scenarios. Life getting better or life getting worse. So if you identify GDP as the only variable which is going to affect the ability of your members to repay, you would need to think about at least one scenario of GDP improving and at least one scenario of GDP decreasing. If you believe in the next 12 months, there's a chance that GDP could grow by 3% or decline by 2%, then you start there. The majority of you will have a starting point based on your delinquency history, and that change for the positive or negative over the next 12 months will make up a very small probability of what could happen. All right, so the starting point is important. These projections will then add or decrease the provision based on that. Okay?
Thanks, Dwayne. Hopefully that kind of shed some light on things. I guess, just to really summarize, IFRS 9 and provisioning. Kyle had said it a while back in one of his presentations, which was what's going to happen is that losses or potential losses are going to be reflected earlier than they are presently. Dwayne alluded to that by saying, if, for example, a loss of on a $100,000 loan was $40,000, presently we would recognize that $40,000 when it is incurred, i.e. the person stopped paying, there's no way for you to get anything, so you have to recover what you can, and you may incur a loss, right? What IFRS 9 is saying is we don't want that $40,000 being recognized when the loss is incurred. We want some portion of that $40,000 being recognized on day one. And some portion of that $40,000 being recognized if there's a significant increase in credit risk with respect to that particular client. So we all know, right, when there's a significant increase in credit risk, you put them on a watch list. For example, before somebody defaults on a loan, what might happen is there may be a change in circumstances of the particular borrower. You know, like they may have moved on to another job or have lost a job, but it's still paying your loan on savings, right? But now, because they're paying out of savings until they get a new job, there's a heightened degree of credit in terms of the fact that they may not pay. Not saying that they won't pay, but they want to watch this and start to talk to the person and say, well, okay, how things are going, you know what I mean? How's the job hunt going? And if they get another job and they're able to service the loan, cool. If they don't, then it becomes progressively, there's a greater chance that they wouldn't actually recover, they wouldn't actually be able to pay the loan, so then they'll go into arrears. So the standard is what Dwayne was making reference to, but then some part of that 40,000 should then be recognized at stage where? 2. So you might find, based on how we get that number is really what Kyle's going to talk about, right, in terms of that. So we're trying to figure out that, right, is really how do we get this number on day one of that $40,000, whether it's 10,000, how do we get that in stage 2, which might be another 15,000. So even before the loan went bad, how much we have charged in the P&L by then? 15 plus 10 is how much? 25. But under IAS 39, none of that would have been there, right? Under IAS 39, how much would have been there? 0. But under IFRS 9, of the 40, 25 there already. That's the change. And what we're trying to figure out is how to figure out that $10,000 and how to figure out that what? 25. So when Dwayne put up that about perspective and looking backwards and doing that, he was trying to get a methodology. And as an auditor, when Kyle does his business, we'd come and say, okay, Kyle, these are the inputs into the model. We want to validate that as the auditor, right? So we're going to check that, right? Dwayne, that's what you do, right? And then in terms of when we validate that, then the next thing you do say, okay, this is a model. When it runs through that is the answer. We check one to see that it works, and that's how we get audit comfort. So from an auditing perspective, the important thing is the data that goes into the model, right? And getting that data. And the question is, what is that data and what is acceptable, right? So recognition of losses earlier. That means it impacts. Remember, Dwayne had said earlier on in his slide where he talked about what? The loss being recognized when? Being recognized earlier, impacting on what? Profits and impacting on ability to pay dividends. That's where that slide comes from. And this is the impact of that. So credit union impairment provisions are likely to be bigger and more volatile because as things, your outlook on the future changes, what will happen? The provision will change. If we improve, less provision. If it gets worse, more provision. All right? Next thing. Credit unions must now incorporate forward-looking information. So that's what Dwayne was alluding to in terms of that. Yeah, PDs, EADs, and LGDs. So we gloss given default, you know about that. These two are new. Probability of default. That's how you get that first salvo in terms of a provision. And EADs, right? Determining what is a significant increase in credit risk, because once you determine that, you put in more losses in the P&L, right? When do I have a trigger for there to have been a significant increase in credit risk over that customer or those group of customers? And when that happens, all of a sudden you're saying more charges to the P&L. And Dwayne also made the point that if things improve, then that could reverse. In other words, you had that charge to the P&L, things start to look better, and we don't need all that provision. And so we move from significant increase the credit risk back to the first stage, probability of default in 12 months. So you can actually have an improvement in a credit going back through the P&L if that happens. So it doesn't stay there forever. Existing data likely to need what? Amending. So first of all, you have to figure out the existing data, cleanse it, put it down. So that's what Dwayne was talking about, going to files. What was basically, was there any thought process when you granted loan? You know when you granted loan? When you granted loan, did we do any evaluation? If we didn't do any, how we treat with that? There are fixes to that. And finally, there will be extensive disclosures required. Why? For moving from IFRS 9, from IAS 39 to IFRS 9, and also going forward, explaining to readers what is going on with that provisioning. So there will be more disclosure. So that has known to increase 20 pages, the accounts 10 to 20, banks 40 to 50 pages. So more to confuse, increase in audit fees, thank God. No, sorry, more information for investors, nothing to do with audit fees, right, in terms of that. But it has had nothing to do with this. And finally, there will be a significant increase by the regulator, because now he has to kind of look and see, are we complying? And what are the risks now associated in terms of including these bigger provisions in the profit or loss account? Yeah. So I think
just two things to reinforce there, and we said it several times. The first is that over the life of the asset, there's no change to the loss or gain that is going to be recognized in the financials. All right, and I want to reinforce that continually, because it is not that you recognize more losses. If you recognize a loss up front and the loan continues to maturity and doesn't default, then you have profits being recognized later on. Because what you're saying is this loan has performed better than your historical experience or your projections, right? And you refine your projections based on tracking performance. The second thing is the reason for the additional disclosures is because the standard is principle-based and not rule-based. So compliance for you may look different than compliance for someone else. So what you need to do is document your reasons for holding a portfolio, how you treat with liquidity requirements. If you need liquidity, do you turn to that portfolio first? Historically, have you had lots of sales out of that portfolio? Things like that. Inherently, you all who have run these credit unions for years and years know. It just comes to putting it on paper. So the documentation that Hasib referred to of the additional 20 pages, you would find is not as difficult as it sounds, because it is really putting on paper what you know of your business. This is why we invest in bonds. This is why we invest in shares. This is what has happened in the past. And this is what we would do if we needed cash. And that does not have a particular look and feel. That is based on your business. Similarly, there are different ways to comply with IFRS 9 from an impairment perspective. What you need to do is explain how you've complied. How you comply is different from someone else. All right, so if your credit review process involves looking at the ratio of the loan balance to shares and looking at the debt service ratio, you put that on paper. If you have a review process which takes place annually or every 3 years or whenever the person comes back into refinance, you put that on paper. The more you document, the easier it becomes for an auditor or regulator to understand how you've complied, and the less questions you're going to get. All right? And again, it is not based on a rule which has no bearing to how you run the business. It's based on the principles of running the business and ensuring that you're being consistent in translating those principles into numbers in your financial statements. Okay? And I think that's it for us, because questions will be taken at the end, right?
Yeah.
Yeah. That's right.
Thank you, Dwayne and Hasib. At this particular point in time, we invite you to take a 10-minute break, and we will reconvene shortly. Before we begin, some persons have been asking whether or not the last presentation done by PwC is going to be distributed, and yes, we will be forwarding via email. At this point in time, we are going to invite Mr. Kyle Rudden to present on the practical solutions for credit unions. Kyle is a managing director at KR Consulting Services. Just a brief bio. Kyle Rudden is an actuary and chartered accountant with over 30 years' experience in financial services consulting, a former president of the Institute of Chartered Accountants of Trinidad and Tobago, and former director of the Central Bank of Trinidad and Tobago. He currently heads a team providing actuarial consulting services throughout the Caribbean and beyond. His team specializes in practical solutions to the challenges of applying international financial reporting and actuarial standards in developing countries and illiquid markets. He is also involved in several international initiatives on values-based business development and professional ethics. Kyle has been associated with the credit union movement in the Caribbean for many years. He is very concerned that the requirements of IFRS 9 will lead to significant burdens on smaller financial service entities, particularly credit unions, and will cause further slowdown in lending and national development. Over the past few months, he and his team have been conducting training sessions on IFRS 9 and developing practical solutions for smaller entities. Most recently, he was requested by the Financial Services Regulatory Commission in St. Kitts to speak on their non-bank regulated entities, including credit unions. Let's welcome Mr. Kyle Rudden. Thank you.
Check. Hearing me? Okay. Well, good morning, ladies and gentlemen. It is a pleasure to be here because you represent the persons responsible for your membership and by extension the credit union movement in Trinidad and Tobago. And this really is quite a nasty standard. And I was at, and I'm getting a lot of echo. I was actually at, try this instead. Go away, go away, go away, go away, go away. My notes are over there, though. But like Hasib and Dwayne, you do this enough, you actually get to know it by heart, right? What was I saying? So I was at an ICAT seminar on IFRS 9, and the following day, at the continuation of the seminar, I said that I hated this standard, and I got almost a standing ovation. You were there for that? You didn't hear the crowd clapping? And that was accountants. Far less us poor people in the credit union movement. So I have some controversial things to say, but I'll leave those for later on in the presentation. I'll go through the boring things first. That's what you call a teaser. It means you'll actually listen and stay. So I learned this many years ago from Americans. This is a disclaimer. It's fine print, so you can't read it. It's kind of those drug ads. You know, why don't you take this for depression? Side effects include death, and you've seen American ads. But this basically says you can't sue me for anything, and please take your own advice on anything I say. It might be wrong. So what do we hope to do today? By the way, we put out handouts on your tables for those of you who might want to take notes or need paper to throw away at home. And I believe CUNA will send out email with
this in soft copy as well if you want. So we want to talk, we have an hour. When I went to somewhere recently, they made me talk for the entire day on this. I said, this does not need a day. They said, no, we are used to having lunch in the middle and this and that. So I literally had to talk on this for a day. So here we go. You got an hour. Today, this hour, I want to touch briefly on some of the problems with this expected credit loss model, real life problems. I want to touch on hopefully some of the solutions. The challenges are always easier to identify, though I think I will actually, unfortunately, identify some challenges you may not have seen yet. I also want to discuss a practical case study we actually developed for a small bank in an island which will remain unnamed, which is a small island in Trinidad. Because one of our key things here is the concept of proportionality, which means everything we do should be proportional to the need. And I want to come back to that in the last few slides and have some discussions. And I'm looking forward to the panel discussion. Some of my credit union colleagues have already told me that they have hard questions for PwC. Thank you. That's ex-PwC, many, many, many years ago. I should make that disclaimer. I used to work with Pricewaterhouse, I don't know, about 20, 30 years ago, thereabout. Hasib taught me how to play all fours in San Fernando. True or false, Hasib? True. Many, many, many years ago. And I think Dwayne and Hasib have gone through a lot of the technical background. It is an incredibly boring standard if you actually want. If you have trouble sleeping at night, don't go by any doctor. Just read International Financial Reporting Standards. Listen, they're really boring. So I'm just going to skip over some things. One thing that, the key point is you have to set up a provision on all your loans, good, bad, or indifferent. We assume we're already setting up provisions on your bad loans. The key, or the initial operational difference is all your loans, as you give them, you set up a provision. This used to be called general provisions back in, for those of you who have more gray hair. Back in the day, accountants used to require you to set up general provisions for the losses you expected might happen in the future. Then the IFRS got rid of them, and now the IFRS is bringing them back. So, just headache. One interesting thing that isn't necessarily too obvious is loan commitments. For most credit unions, that is not going to be a problem. For the bigger, more fancier ones that have mortgages and more diverse loan products, it runs like this. Even when you have approved the loan, before you give the man any money, you have to set up a provision. At this particular point, people say, what? Seriously? I get this in Barbados, in St. Kitts, and pause for an argument. Yes, you have to set up a provision when you haven't even given the loan yet. Now, one of the key elements of accounting or financial reporting is something called materiality. Don't get hung up on doing this if your loan commitments are a small percentage of your portfolio. I mean, why bother? Remember, materiality, materiality, materiality. That is one of the things you have to use to defend yourself against most of this standard, materiality. It's a word you need to learn. Kind of like, if you have a vampire coming towards you, you do this, right? If you have an auditor coming towards you, you do materiality. So, and if I had more time, there's a very interesting paper that the IFRS put out on materiality, and we should send you that link. Shogun, can you please send that link to CUNA to send out with the materiality paper? Because it actually goes into details. So for example, you may read a financial standard. Now, I know most of you are not accountants, so I'm not going to bore you with accounting things. But inside those boring things that those accountants read, a standard might say, you have to disclose this. It's a mandatory disclosure. And because of that, we tend to interpret that even if the answer is 0, we have to disclose it. The practice standard on materiality, which came out in September, clearly gives guidelines and says, practical common sense. It literally says, even if a standard says this is a mandatory disclosure, if it's not material, forget it. We might actually reduce some of these pages of notes we have in this. So for those of you who have accountants, or for your accountants, please let them read that practice standard. It gives you an upgrade cross for chasing away auditors. which is very important. It's kind of like holy water or garlic, I guess. So, you know, everybody is a vampire. Have you seen how many vampire TV shows they have? Everything is a vampire. So, loan commitments, another operational headache. So I'm going to just run through, for those of you who saw me in Guyana, same example. So the Guyanese people, you don't have to watch this. Now, I happen to be the director of a small microfinance, rural microfinance. So this is wholly coincidental that I have chosen the example of a hypothetical rural microfinance, which may be in Mayaro. So, this is what so let's assume we have a rural microfinance company. The average loan losses is 5%. Year on year, I lose 5% of my loans. If I look back historically, total loan losses divided by total loans is 5%. I also happen to know, on average, if I have a bad loan, I'm going to lose 40%. Fine. I have 8,000 loans that are performing and 2,000 loans that are not performing. I have $10,000 in loans. This is what my balance sheet looks like right now. Remember I said I have 8,000 good loans, 2,000 bad loans. Or for those of you on this side, I have 8,000 good loans and 2,000 bad loans. So for my bad loans, I know I'm going to lose 40% of the money. So I set up a provision. So this is my net balance sheet on our current model, which is, I don't set up a provision for these loans, they're still good. The bad loans, I set up a provision. I'm going to lose 40% of my money. 40% by 2,800. So this is my balance sheet. This is my IFRS 9 balance sheet. Identical, basically. Most of us, one way or another, set up reasonable provisions for the loans that you know are bad. Those are the ones you give to the collection agencies and you see what security you have and how much am I going to get back and so on. But we don't normally set up these loans in advance. What this basically does, what IFRS 9, this forward-looking model says, listen, guys, you know you're going to lose 5% on any loan you issue. Set up a provision one time. And so you do 5% of $8,000, and you put up a provision one time. From loan inception, basically. This is the basic concept behind the whole thing. And for those of you who are a little bit older, this is exactly what we used to do 20 years ago in banks and financial institutions. And then it became illegal. So now it's legal. Not even legal, required. You know, what goes around comes around. So that in essence is the concept. And you saw what we did there. We took a backward look. We said, okay, on average, how many loans have we lost in the past? 5%. But this rural microfinance, as with most of Trinidad and Tobago, is affected by oil prices. So what if I expect oil prices to be going down, and that's going to be affecting my economics in the country or the area, and there's a greater risk than in the past of loans going bad? Well, in that case, we have a scenario, this is the previous information, but now we have some new information. And the new information could be a natural disaster. There is a hurricane, Dominica. There's a national credit downgrade or negative outlook, or oil prices are going down. And so you suddenly think, you know what? Nothing has changed with your credit union or your microfinance, by the way. You just think that things are going to be worse. Well, fine, set up more reserves. What was 5% becomes 15%, and you set up a reserve, a bigger reserve on your good paying loans because you have a greater probability. Now, one of the things that should immediately hit you there is the subjectivity of this. All right? Huge subjectivity. Immense subjectivity. You could make up numbers and put them in there. Well, who are you to tell? Because we don't have data. Okay? So there is no, this is not, as I point out, this is not bigger country, plenty data. Broward County in Florida has 1.8 million people. And they wouldn't try and do the calculations for Broward County that we are supposed to be doing for our small island economies in the Caribbean. They would do the calculations at a state or federal level. But the theoretical way I'm supposed to do this, I have my projections of oil prices. Based on my historical data, I have mathematical models that predict how farmers in Mayaro react to prices in oil changes. And I've modified this and and I have variant. Seriously? That is what I'm supposed to do. And I'm supposed to now distinguish this between watermelon farmers, young farmers, female farmers, old farmers, and now the thing is, if I was in the US, oh yeah, it's all there. I'd have all the information I want. Now the thing is, I can actually apply those mathematical models, assuming, let's pretend I have all that data. Okay, I have all that data. The real problem here is the sample size is too small. When you have a small sample size, you get a lot of statistical variance. It jumps up and down, which means any answer you come up with is statistically unreliable. So why do I have to pay actuaries hundreds of thousands of dollars to come up with a statistically unreliable answer, which is meaningless? I don't know. Maybe I need to send my grandchildren to school or something like that, in which case we take donations. But apart from that, this is meaningless. But we'll continue. So you understand the basic concept. It's subjective, number one, historically. It becomes ridiculously subjective when you're looking for forward-looking. None of us can tell. You cannot tell me. All right, you have now segregated all your loans by sector. You know exactly which of your members work in the construction sector. The construction sector is heavily influenced by oil price, historically in Trinidad and Tobago. So you know your construction loans are going to go worse, right? How much? 10%, 5%, 50%, 13%, 22.85127? I don't know. And then you have to feel sorry for the auditors, right? Because even after you come up with this, they have to say, well, is it right? Is it reasonable? Well, of course it's reasonable. They said the right number. I being me, you, anybody. Because we don't have any good data. Even if you had good data, it's not necessarily a predictor of the future. So yes, so theoretically, you were supposed to do all of this. You're supposed to do the best unbiased estimate based on all reasonable and supportable information available at the reporting date without undue cost or effort about past events, current conditions, and forecasts of future economic conditions. All right, and what is the smallest credit union we have by number of members, roughly? 40? Okay. 80? Down? Right. I'm supposed to do this? Seriously? Let's move on. No, I have some wider questions about that. Because, I mean, fine, if you want to get rid of every small credit union in the country, well, just pass legislation. Don't go through all this foolishness. But anyway, so as the accountants would tell you, they have, on your good loans that started good and are still good, translation, there's been no significant increase in credit loss since origination, in credit risk since origination. You hold the expected credit losses you expect on 1 year. Now, if sometime during the life of the loan it moves from, well, there is a significant increase in the expected credit risk, then you move it to from, let me not just hold what I expect to lose over the next 12 months, but what I expect to lose over the whole rest of the life of the loan. That's what Dwayne was talking about, bucket 1 to bucket 2 to bucket 3. Okay, fine. It is more complicated than it looks, and you can, I'll tell a story out. I'm not being taped, am I? Yeah, I'm shucks. All right, fine. I'd like to recognize my colleague, Shogun Superside, who's sitting at the back there, standing at the back there, who has a first-class master's in financial mathematics from City University, London. I'm sitting with him watching a presentation to accountants with a bunch of Greek letters and maths on it, and he turns to me and says, what is that? So, all right. So if we're watching this stuff on the screen and say, what is that? I mean, seriously? Anyway. Now, so what are some of the modeling issues? Don't worry, I actually have some better news than all this when we reach towards the end, okay? But I think Dwayne and Hasib would have, made you feel bad enough already, so I don't need to continue that process. So theoretically, you're supposed to model your past loss patterns, you're supposed to track your credit risk history, you're supposed to build and test your credit risk models. Banks tend to categorize loans into 5 or 7 categories, ranging from 1 to the best, to 5 or 7 being the worst, and anything under 4 is a bad loan, and that type of thing. To my experience, many credit unions did not do that. The credit union model of lending, unless you want to be a big fancy one like the one we hear, is actually a very simplistic thing. People put together their money and you're lending towards social needs. It's a completely different philosophy and mindset. But this is what you have to do. So what about problems? Data is often not available, or it's not in easily accessible means, and we see this in different lines of business. There's not my phone ringing. Right, good. I remember doing that at a seminar once, after asking everybody, please switch off your phone. Then my phone went off when I was speaking. Really embarrassing. So I'm just checking my phone is in fact off. The data sets are too small. Ooh, what did I just do? Did I just shut it off? Press a button? Oh, I'm getting better at this. So, yeah. So while the technician is putting that back together, what is the next one here? There we go. Note to self, don't press that button again. Right, this one. The data sets are too small to be statistically reliable. They really are. To give you an example, if you're doing statistical modeling and you want to achieve something called credibility, you usually want about 1,000 default events. That's not 1,000 loans. That means 1,000 bad loans. So obviously, if you have an 80-man credit union, you don't have 1,000 bad loans. And theoretically, you need 1,000 bad loans in each category that you want to model properly. That does not exist for any credit union in Trinidad and Tobago, and I think actually the larger banks in the Caribbean have difficulty achieving credibility status, statistical credibility. The standard loss models are not appropriate. I remember doing, long before IFRS 9, several years ago, a Caribbean bank had approached us to look at some credit loss modeling, and they were looking at credit loss modeling software out of the States. I think it was Rissmetrica. If I am in the States, everything is credit rated. Everybody is credit rated. If I walk into a car, all those dealerships, where they see, come on, drive your Mercedes-Benz for $200 a month and that kind of thing. When you walk into the car dealership, you just wave your social security number at them. They know your credit rating, and they tell you yes, no, how much they charge you, and you walk out or you don't walk out. That's it, done. We don't do that. We don't even have an effective national ID number. No, seriously, we've discussed it for many years. Each administration has had a project on it. We have a significant level of unbanked people. We have a significant level of people but yet, you really can't do that without this kind of information. So you do credit loss modeling. The mathematical models are based on information that does not exist, and also on markets that are quite different. So please be very careful about what models you pick up to use. The other thing that I actually learned this from Hasib, unlike most accounting standards, when they come out, you usually find some smart person or foolish person somewhere else in the world who has early adopted it. And so you go and see what they did. Everybody is keeping away from this. They don't want to do it. The reason why it took so long to do is because the banks in Europe objected to IFRS 9 for literally a decade, maybe 15 years. And it's really only because, you had a global financial crisis and the world politicians are putting pressure that you have this thing coming. But nobody wants to do this. All right. Let's talk about the case study. So this is a small retail bank in a Caribbean island. And like many of our entities, especially in the smaller territories, They do everything. Car loans, mortgages, this, that, and the other. They have less than 2,000 loans on their book. So, see, if I'm in a big country, I get a bank, one bank, I'm just doing mortgages. I do one thing. You get depth. Here we get breadth, which means, and when you look at any credit loss modeling book, they'll tell you, well, you know, mortgages are different to retail loans, which are different to this, which is different to that, and you have to treat them all differently. Well, in this one bank with 2,000 loans or less, I have everything. Car loans, consumer loans, mortgages. I might have 5 of this, 3 of this, 2 of that. And I'm supposed to develop some kind of fancy statistics on this. Okay. And so, okay, let's take a look at it. When you're doing credit loss modeling, first thing you do is you gather information. Okay, small bank, all right, fine. And like any good bank, they have their loan categories, with 1 being the best down to 5, 6, and 7 being bad, 7 is write-off. And so I say, okay, give us the loan information. Give us the balance sheet information. Get some financial statements, let's go to the economy. The next thing you do is you review the information. And then you start scratching your head. And this is not a function of just this bank. This is a function of many financial service entities in many lines of business. Basically, the information didn't make any sense. You give me a loan listing and it doesn't tie back to your balance sheet by big numbers. That's not very useful if I'm going to build a credible model. And I'm supposed to go and convince the auditors that this thing makes sense. All right. This is actually something we have a lot of experience in. Not so much this, but Sherman, my tall mathematical genius standing at the back there, actually deals with general insurance companies. And recently, general insurance companies have wanted a lot more calculations. So you go in there, and this is in the year 2012, 2013, and you're asking for claims data, and it's all still manual. Okay? Literally, the claims data was manual, but you're supposed to, you know, manual does not work well on Excel. It just doesn't. And a lot of the ancillary information in banks even, though it's improving, is actually manual. What I mean by that is, okay, I get a schedule now, and the security schedule is just a comment with like house worth this, car worth that type of thing. You can't manipulate that. You know, it's like, how do you sort that? What is it? It's not like a column for house and a column for value of house and a column for, because the systems that we use to manage our loans didn't need that. And that's the real problem, because our systems don't produce the data you need to do all these analyses. So what did we conclude? Oh, by the way, there were no loans. So this is supposed to be their loan portfolio, where they rate all their loans, and they tell me, yes, we review all our loans annually. In this entire list, there were no loans that were bad. But I can see there are bad loans on their balance sheet. So it turns out that they don't actually update their loan rating, which means this was useless. Because one of the models, one of the theoretical models, one of the simpler theoretical models is you track how loans move from credit rating to credit rating over periods. So a loan that started out at 2 and then it went to 3, and then you try and work out the probabilities of moving between those sections. But these people weren't updating those. So all I had was the original. Okay, fine. So throw out that entire set of models, and those were the easy ones. So what do you do next? You think. Now, you'll bear in mind that we, like you, this is an evolving game. I was very happy to hear that Pricewaterhouse is trying to do it with lots of credit unions in Jamaica, because that's actually the only way this makes any sense. So, but we're still developing. This has not been done yet. So sit back and you realize, well, you know, even if we did the calculations, their loss ratios are going to be so crazy from only 1,000, 2,000 loans, because it's going to look like 0, 0, 0, 0, 300%, 0, 0, 0. I mean, what do you do with that? You can't do anything with that. So let's see what else we can find. And so we started looking for patterns in the financial statement. The bottom line of this, by the way, is how a very, very simple model complied with IFRS 9. So we started looking for patterns in the financial statements. And we made a few assumptions that basically they knew what they were doing on the bad loans they were providing. And so, you know what? Let's divide the annual loan loss provision, the expense for the year, divide by the performing loans. Now, if you're